Welcome, everybody, to the rCFO podcast series, the podcast that speaks to the CFOs of the world and their teams, as well as institutional investors, about how one does regenerative finance and regenerative financing can change capital flows into ESG-oriented innovation, solving some of the greatest global needs that we have in our society today. Today, I am very pleased to bring to our video recording here Paul Herman, who is the founder and CEO of HIP Investor. Paul has been in this space for many years, and HIP is now in its 15th year. Paul, welcome to our CFO podcast series, and please introduce yourself and give us a couple minutes of your background, please.
Sure. Thanks, Scott. Great to be here and excited to share the latest in what makes a sustainable, responsible, impactful company and investment. I'm Paul Herman, based, as you can see on video, here in San Francisco. And I founded HIP Investor a decade and a half ago. So HIP stands for Human Impact and Profit. And we do three things. One, we rate investments for investors. We produce ratings for issuers, just like Moody's or S&P or Fitch does on credit. We do that for impact. If somebody's launching a new bond or equity or financial instrument. And then the third thing we do is we work across sectors to advance things like climate action funding. Because not only are companies funding climate action, but cities need to fund climate action. So you can find all three of those things on our website. We cover more than 10,000 global equities. So if you work for a public company, there's a high likelihood we cover your public company. We rate more than 100,000 muni bond entities, not only cities, counties, and states, but schools, hospitals, roads, energy utilities, water utilities. And then we also rate real estate and hedge funds, venture capital, and private equity. So all that gives you an impact score on your portfolio, so you know if you're investing more impactfully or less impactfully. And the focus is on ESG, environmental, social, and governance. We call it people, planet, and trust. But we've been doing that since the very beginning. Before there was ESG and before there was impact investing, there was HIP. And then we publish our research with on sustainablebrands.com with nonprofits like Carbon Disclosure Project and As You Sow, as well as Wiley publishes our books. So our first book was 11 years ago called The HIP Investor, Make Bigger Profits by Building a Better World. So that was on Earth Day 11 years ago. And this year, the new Global Handbook of Impact Investing, which is 1,300 pages, bigger than War and Peace. There's more peace than war.
Wow.
And that's a how-to handbook that you can use as an investor or as a organization. So delighted to be here and dig in.
Paul, thanks. By the way, I got a copy of the book. And it is bigger than War and Peace, but I have begun reading it, and it's excellent because it breaks topics into bite-sized chunks by various authors, and then you're editing over the top of it. So it really is the reference guide to this subject. So I would recommend that to anybody seriously interested in this topic. So we're going to take a little bit of a different detour. Oftentimes, Paul, I know you talk about integrated reporting and shareholder disclosures and so forth. We have, as the viewers know, a 5-pillar framework within the regenerative CFO: governance, science-based goal setting, systems and decision making, regenerative financing, and integrated reporting and advocacy. And so you and I have talked about starting today with a conversation around the governance topic as it relates to within ESG. It's an area that I know you have keen awareness of and insights on. So let's just jump in. I want to start with maybe the big why question, which is, in your research, how strong is the evidence presently that ESG factors matter in terms of board governance?
It's very strong. in some of the metrics we track are the strongest of any of the factors in environmental or social or governance, which we call people and planet and trust. In fact, when we first started HIP a decade and a half ago, and we reviewed all S&P 500 companies, and we ran essentially analytical model, an optimizer, one of the highest rated metrics was what is the legal exposure of a company? Who is suing a company and for how much? And if you think about when you get sued, either as a person, hopefully not, or as a company, hopefully not, but when you get sued, you're getting sued because you've breached trust in some way. You've breached expectations. And that can be anything from treating customers shabbily, not paying employees fairly, or firing employees unfairly. It could be the government or nonprofits suing you for polluting the environment. It could even be competitors suing you for stealing intellectual property. So when companies have a longer description in their 10K and annual reports, which are mandatory required reporting, on the mix of who's suing you for how much and what this either paid out historically or might pay out in the future. That is a super strong indicator. And so not getting sued, how do you not get sued? You treat people right. You treat your employees right, your customers right, you treat nature and the environment right. You even treat your competitors in a fair way. We want to have sports events with, sports events have referees and boundaries. We don't need a libertarian governance system. We need a fair governance system for everybody. So that's just one of the deep metrics. And it was so optimized that when we ran the model, the optimizer just focused on that as one metric. But we didn't want one metric as a model. We wanted a multi-metric model. So others in the governance category include lobbying. So most organizations don't lobby for the benefit of others. They lobby for self-interest. Even eBay, we thought at one point, since they are the main revenue source for a couple million people, we thought they might be lobbying on behalf of their customers. They don't. They lobby on behalf of eBay. In governance, we also put things like sustainable 401ks. When you offer a sustainable retirement plan, that gets employees engaged in the business, and they start thinking about the customers and suppliers of the business, whether those are stocks in their 401k plan. Certainly things like CEO pay are a main driver. And so with As You Sow, we've done 7 years of overpaid CEOs. And what we found every year is the firms with overpaid CEOs underperform financially. So in a portfolio, if you were to exclude, short, or tilt against overpaid firms with overpaid CEOs, you would have a stronger portfolio. And lastly, a fifth metric that we look at, legal exposure, lobbying, sustainable 401k, CEO pay, is gender and race diversity at the board level. And that board diversity helps make better decision making. And this isn't really trackable yet, but when there's stakeholder diversity on the board, having somebody from a nonprofit, having somebody from a labor union, which many companies have had in the past, those stakeholders help the board make better decisions. So yes, super strong, super informative. And when you're managing portfolios like we do or rating organizations like we do, it's a super strong factor.
We're digging into the practical side of this, which is what I love. This is about adopting, executing, operationalizing these sort of things for the CFOs and how to do this. So what does a board, and maybe you can give some examples if you want to, because it's all public information. What do they actually look like? You mentioned a couple of the things that they do, but what structural changes can they make that shows true emphasis in concern regarding this area?
Yeah, so first of all, boards need to decide their makeup. There is usually a board committee on board recruiting and maybe even board retention. And so who's on the board? And many cases these days, the board members certainly represent the investors. And there's investors who seek to run to get elected on the board. And recently, Exxon Some of you may have noticed that Engine Number One, a small activist fund, got a slate of electors elected to the board to finally start addressing climate change and climate action at Exxon. So that's one, who's on the board and what stakeholders they represent: customers, employees, nature. Um, so you'll have like Lisa Jackson, who used to be the head of the EPA, on the Apple board to help bring the environmental profile and maybe government relations. Um, you also think about age, like how many young people are on your board. When you look at boards, most of those people have gray hair, if they have hair at all. And so having an age diversity, a gender diversity, there's lots of evidence showing, and we've shown this all over our whole decade and a half, gender diverse boards are stronger decision makers than non-gender diverse boards. Um, and by the way, there's no board, publicly listed company with a board of more than 60% women. So you're lucky to have over 50% in a handful of companies, like L'Oreal is one. So that's the first thing, is, look inside, who's on your board. The second thing is, what are your targets? What are your, not only your financial targets, what are your business value driver targets? And how do you create value? You create value by inventing new products and serving customers. So what are your people targets? Who are you hiring and what level? Boards can help set targets. Like at 3M, they've historically had a target of 50% of our products must come from 50% of our revenues must come from products invented in the last 5 years. So you need an innovation engine to do that. And one academic paper I'll refer you to is from the North Carolina State University. Diversity of the workforce actually produces innovation at twice the rate of a non-diverse workforce. So you can get 2 times as many product inventions and patents. Another is setting targets like around people, planet, and trust. And one of them is around diversity. 95% of S&P 500 companies have diversity policies, but only 19% have diversity targets. And so your firm may already be under pressure to release your EEO-1 statement, which traditionally is a confidential document between your firm and the government. Investors want to see that data. They want to know who you're hiring, at what levels, across gender and race, and they want to know what the pay gaps are. So the board, if you can attract the best talent and you can have no pay gaps, so you're paying people equally for equal work and equal results, you will have a dynamic innovation engine. You can have a dynamic innovation engine that will outperform your peers and competitors. So those are tangible things the board can do. And then one last thing on this question is the capital spending, the CapEx process and allocation. Even firms like Shell have a carbon price as they evaluate oil and gas projects and energy projects, and hopefully more will be renewable energy projects and oil and gas. But there's a hurdle rate, there's a carbon price hurdle rate, there's a cash flow hurdle rate, ROI hurdle rate when baking in a carbon price. And so if you are not embedding people, planet, and trust metrics in your management systems, like CapEx, resource allocation, people allocation, retention of talent, then you're missing out on an opportunity to lead, to beat your competitors, and to lead the market. So those would be some things on the board to-do list.
That is a pretty exhaustive list. My guess is not all boards, or not many boards, do that comprehensively. Very much appreciate pricing carbon into the decision science. I've been working on some activities with some professors at Santa Clara University on adding an ESG factor into the beta side of the capital asset pricing model to actually mitigate the beta a bit when ESG factors are placed into the equation, actually lowering cost of capital. We know, for example, bonds, green bonds, we can, if you practice healthy, holistic economics, balanced stakeholder economics, that your cost of capital actually does drop. So there's a direct benefit there. let's shift real quickly over
Yeah, let me
to
just add on one thing to that, Scott, because that's really insightful and innovative what you're doing with Santa Clara. And we put a conceptual model in the first HIP Investor book, actually, on page 222 of the HIP Investor book, which was what is the risk return, modern portfolio, if you applied modern portfolio theory, what does the risk return profile look like across asset classes? And we conceptualized that you would have lower risk or higher return so that you would have a more efficient portfolio on that modern portfolio theory. And what has been found over the past, decade and a half, 2 decades, is it's true, is that companies that have high sustainability scores, 9 out of 10 times are lower risk, are less volatile. 6 out of 10 times have higher returns. And in our ratings of 10,000 global equities, which we look at every quarter and mid-year and end of year, higher HIP ratings, higher sustainability ratings correlate with higher total shareholder return, and lower HIP ratings, lower sustainability ratings correlate with lower shareholder return. So it's playing out in reality. And so your portfolio model and integrating that into portfolio equations is supported by tangible evidence.
the interesting academic side of the question is how do you establish the weight in the model? And we'll save that for the conference as it's coming up here in November.
Yeah, excited for that.
Walk through just for a moment, if you would, kind of how the CEO fits into the governance framework. What are the kinds of things that he or she should be doing or looking at? Things like compensation factors or key indicators, maybe an ESG committee, like there's an audit committee or a compensation committee. What are some of the things that the CEO should be doing directly to ensure excellent governance at their board?
Sure. I mean, there's the CEO on the board and there's the CEO in the company. And for many companies, the CEO is at least on the board and sometimes the chair of the board. So I think a key element for the CEO on the board is what's the elements of board independence. The more stakeholders you have, the more independent the board's going to be. And the better signal, the better decision making you're going to get on the board, and the better signal you'll send to the market that you take stakeholders seriously and you take these ESG, people, planet, trust driving factors seriously. On compensation, tying compensation to value drivers, we talked about how diverse people and talent themselves drive innovation. So don't just measure innovation, measure the talent creating that innovation. That happens a lot when there's mergers, that they want retention bonuses for people involved in intellectual property and the like to keep them on board. The audit, we're not aware yet of many public ESG audits of the value drivers related to sustainability being reviewed by, audited by, or paid for in an actual audit. So, Coca-Cola launched its water metric about more than a decade ago after the drought in the Southeast in 2006, where they said, oh, we might not have product to deliver to our customers. And, it's pretty shocking when you think about this. When you drink a unit of Coca-Cola, it takes 3 units of water to produce 1 unit of Coca-Cola, the 0.9 water that goes in the bottle, but another 2 units of water. So, and it's worse for beer, I'm sorry to report, 4 to 10 units of water for a unit of beer. But Coca-Cola got that down from 3 units to about 2 units over a decade. And so having audit review, even things that aren't on your financial statements, water is usually underpriced or free. And so once you start tracking units of production, not just costs, that helps. So making sure that you have high transparency into the business. Another thing the CEO can do on the board or as a company is be transparent. And the rush to environmental social governance metrics and sustainability metrics, if you can't see it, it's a risk. And so this is different than the 20th century approach to protecting competitive information, or this started to happen in the late 90s when Nike was attacked for its supply chain because of problems in the supply chain. And companies like Nike and Hewlett Packard reveal where their factories are and make them visitable. So turning transparent, I'd say three big things CEOs can do. Become more transparent about material value drivers and metrics. Encourage competitive performance to be a leader, not a laggard on those value drivers. And then the third part is be accountable and enforce accountability to it. And a good CEO would encourage its CFO, or a good CFO would bring this to the CEO and say, we're not only going to do a green bond, we're going to measure the impact of our green bond that we're going to float in the market, like Apple and Toyota and Starbucks have already launched green bonds. And we're going to track that impact over the life of the bond, and we're going to report back on that impact. And so we're going to give some teeth to our securities. And then we're going to maybe even adjust the income payment up or down on that bond based on that, what we committed to. And this can be done with CEO pay too. CEO, executive suite, board pay, even manager pay can be linked to people, planet, and trust metrics. And when you do, it might even engender more excitement, because then it's not just about producing dollars as a target, but increasing employee satisfaction, reducing greenhouse gas emissions, achieving a science-based target in greenhouse gas emissions like exist, having a diverse board. People can rally around those people, planet, and trust metrics that then naturally produce value without everything boiling down to a dollar, even though it can produce a positive return on investment.
For all of our listeners here today, Paul is touching on subjects that are imperatives. And Paul will be speaking at the Integrate Conference at Fordham University Gabelli School of Business in New York City on November 8th. That's a 3-day conference that all this stuff leads up to create regenerative finance function in our companies. Paul, I want to thank you for the time you've given us this morning and ask you for any final summation, any final takeaway that might leave us with a little bit more of an appetite for what's more to come.
Well, I've dropped a lot of breadcrumbs on innovations that companies can lead on, and some of them will be presenting at the Integrate Conference, which we're super excited about. We've been part of since the beginning as part of the first, what was called New Metrics Conference, and now Integrate Conference. So excited to partner with you every year on that, Scott. Just a quick recap. Have a diverse board with stakeholders, not just gender, ethnicity, age, but stakeholders from customers, employees, the environment. 2 is set ESG commitments and put some teeth behind it. A green bond, an equity, warrants that ratchet up or down with ESG performance, a science-based target achievement. And a third one is use the tools that you have inside the company for leverage beyond your company. So 2 of them are a sustainable 401k actually sparks education inside the company by your employees and participants in the plan. But one that just happened this year so far is PayPal allocating $115 million from its corporate balance sheet. So to the CFOs out there, corporate cash from PayPal of $115 million is going to My C Note, which is a fund of community development financial institutions. And CDFIs are community banks that loan to local entrepreneurs, primarily women and people of color. And they have a very high repayment rate. So corporate cash can be used to invest in the community where you're operating through CDFIs to benefit the next wave of entrepreneurs who might even work for your business one day or sell to your business in your supply chain. So these are all like tangible things that are super sexy, super impactful, and add value creation to your enterprise.
A lot there. I love the 401k concept and also love the putting money back in. That can in many ways fix generational income inequality and net worth for families as well. Paul, thank you so much for everything that you do in this space, for the tenacity and authenticity that you do it, And I'm looking forward to seeing you face to face at Fordham here in just a short few months. Thank you for your time. To everybody that's listening, thank you for listening. We keep these relatively short TED Talk styles. Look at integrateconference21.com if you're interested in registering. We'd love to have you show up. The topics will be rich and deep. It is about adopting these measures, figuring out how to operationalize them internally, and then execute on them. So, a very practical conference for practically minded CFOs and their staffs. With that, have a wonderful day. Thanks, Paul.
Thanks, Scott.